Hello, I'm Dave Glover, and thank you for joining me here at InvestorToday.ca. For the next few minutes, I'll be speaking with Mr. Redmond Weissenberger, who is the founder and director of the Ludwig von Mises Institute of Canada, a former industrial designer with extensive experience with industrial trade. He founded the Mises Institute of Canada because he saw a need for the Austrian perspective to be brought to the Canadian context. Today, we'll be discussing the history of gold's function as money and how it can be applied today. Well, welcome, Redmond, and thanks for spending some time with us today. Where do we begin? I mean, what exactly has been gold's historical currency function?
Well, throughout the years, for more than 2,500 years, from ancient Greece to modern USA, gold coins, and I guess the modern world, have served as money and the standard calculation of account. Mm-hmm. Essentially, gold, through the regression theorem that Carl Menger and Ludwig von Mises came up with, essentially, we as a civilization we needed to solve the double coincidence of wants, right? If I've got a shovel and you've got a chicken, and we want to trade, but you don't want a shovel and I don't want a chicken, how are we going to trade?
Mm-hmm.
And so what we as a civilization, and what's interesting, all civilizations around the world came up with essentially was a standard unit of account for trading, and that unit of account for like I said, about 2,500 years has been gold, and there's a few different reasons for that, right? It's gold is durable,
mm-hmm.
It's resistance against wear and tear, which would otherwise depreciate its value. It's difficult to debase, making it resistant to purposeful inflation. It is relatively scarce, so there's little risk of its supply being suddenly expanded. It is highly marketable, and to an extent easily transportable.
Mm-hmm.
It has a very high value to weight ratio. And I'll tell you. And finally, gold is easily divisible and it is fungible, making it easy to store. All right. Now I will tell you. I don't believe nothing has intrinsic value, right?
Mm-hmm.
In that, if I'm in a desert and I've got a bunch of diamonds but no water, essentially those diamonds are worthless to me. Or the gold, depending, all values are relative and subjective.
Right.
Right. So, although nothing has an intrinsic value, gold, over time, it has been proved, has value and has continued to maintain its value throughout the ages. And so we've had a 2,500-year track record of using gold as a unit of account as real money, but it's only been in the last 40 years of human history that we've entered this situation where the world is on this pure fiat currency system, right? Where essentially our trading is based on zeros and numbers in a bank account, mm-hmm. or pieces of paper that are not backed by anything.
So, really, where have we gone since the 19th century? I guess obviously prior to the 20th century, prior to the Industrial Revolution, gold, obviously people were trading in gold coins. It really was the currency of choice.
Yeah, well, it was the currency of choice in the market, right? The marketplace decided that gold was the market. That gold was the currency of choice. It wasn't. We didn't have a government, like a world government from on high, saying this is what everybody must trade in. What it came to is that everybody decided that, in a collective action. Well, I wouldn't say collective, but all the market participants came together and decided mm-hmm. gold was going to be the unit of account. Now, we didn't actually leave. The world did not actually leave the gold standard completely until 1971.
Right.
Throughout the 19th century, what we had known as was the classical gold standard, and this was a global trading system that used gold as the unit of account that countries would settle up with each other. Of course, we also had free banking in various places, but back to gold. Essentially, gold was again, as I said, the unit of account, and we actually had within the 20th, and of course, we used gold and silver. Right, silver was used in more of a day-to-day trading situation. Right,
mm-hmm.
When you hear the term "pieces of 8," oh, actually, you might want to get that because that might not be right. But anyways, when you're hearing, and just in a little aside, you'll note that all of our coins used to be made of silver, right? Our quarters had silver in them.
That's right.
Quarters were silver. Our dimes were silver. Our
silver dollars.
Yeah, silver dollars. And so, for a day-to-day operation, silver was used for small purchases, and gold was used for large purchases. Now, throughout the 19th century, when we were on a gold standard, we had very stable currencies. In fact, the U.S. dollar from the year 1800 to the year 1900 actually gained in value.
Mm-hmm.
And so the reason for that is because when you have a limited supply, or the supply of gold sort of went up by about 3% a year. When you have a limited supply of money, essentially, money is just another good. It's a unit of exchange, right?
Mm-hmm. And it's easier to cart around than, say, a goat or a chicken, right?
Well, yeah, and the value of money is based on the subjective desires of people for other goods,
right?
And so when you had a stable supply of money, what happened is that prices actually fell each year, right? Because you had a fairly fixed amount of money, but an increasing number of goods that you could exchange that money for, right? So
absolutely.
So you couldn't simply double the amount of gold overnight, and all of a sudden all the prices would rise,
mm-hmm.
right? And that's essentially what's happening now.
Right.
But what happened was that through the 19th century, you had the British pound was increasing in value, the U.S. dollar was increasing in value. Up until 1913, we all kept the gold standard, and then when World War I first hit, every single belligerent nation went off the gold standard, because what they wanted to do was be able to, number one, there was no international trade going on, or very little. Number two, they wanted to be able to print money in order to pay for the war.
Right.
Right, and so, and also 1913 was the year that the third shot at a central bank in the United States was created. See, England already had a Bank of England. They had it for a very long time. Canada actually did not have a central bank until 1935. Now, the United States had a central bank twice before, but both times it only lasted a few years,
mm-hmm.
and then it was they repealed the law that had created it, and the U.S. returned to basically a free market in their monetary system.
Right.
Now, so under the gold standard, we had a very stable system.
Mm-hmm.
Right, we had high growth, low unemployment. There occasionally were various banking panics or financial crises, but they were very short
mm-hmm.
and limited in their nature, as opposed to today, where we have these very long, depressions that we're suffering through.
Mm-hmm.
And also, the thing about gold was that you could trust its value, right? You knew that if let's say you wanted to retire, and you had saved your gold up, you knew that in 10 or 20 years, if you had cut back making as much money, that the gold you held would hold its value.
Right.
Right. So the problem we have now, essentially, is that when governments inflate the currency supply, the price of goods and services rises. Right. See, everybody now in today's world says they talk about the word inflation, right? And they say inflation is rising prices. Now, what inflation traditionally means is inflation of the money supply, and one of the effects of the inflation of the money supply is the rising of prices.
Sure. Well, because the more money you have out there, the less valuable that money becomes. Correct.
Well, exactly right. And at a 3% in gold, as gold was increasing by about 3% per year, but you also had monumental growth in the overall economy. You had more growth in, say, I mean, I don't want to use the term GDP because we didn't, I don't necessarily think it's a great measure of the real economy. When you had a slowly rising gold price or slowly rising gold amount, but a much higher economic growth, you actually had falling prices, right? So, but what we have is we have low economic growth, but a highly increasing money substitute supply.
Right.
So we have slow economic growth, and that's what happened in the 1970s, right? It was stagflation.
Right. So what you're talking about basically is how gold became the standard by which currency is valued. And
gold is currency.
Exactly.
Right. So what you had was, and the way essentially it worked, the way our sort of modern banking system came about is that you would have had banks originally were places that just people would store their gold.
That's right.
And it was a warehouse, and somebody would put their gold in there. They would receive a ticket, and they said, well, you can come back and pick up your gold whenever you want. And they would charge a certain amount for holding the gold. Now, the thing is that gold dealers essentially figure, or the people who are running these gold banks, and they're usually goldsmiths, would figure out that they could loan the gold out because people weren't coming and demanding all their gold. And so that's where essentially the system of fractional reserve came about. Right? So the goldsmith might have 100 ounces of gold, and they'd lend out 50 ounces of that gold. And that was an early type of sort of monetary inflation. But essentially, what happened was the tickets, essentially the IOUs that these bankers, that these gold merchants would issue out to the people storing their gold, those became the initial money, right? So instead of people trading the actual gold, going and getting their gold and trading it for an object, what people would do is they would exchange the gold IOUs.
Right.
And so essentially, what money was, it was a representation, a money substitute of an actual physical object, right? A piece of gold. Now, in our currency system, up until the 1930s in the United States, except for certain periods when they went off the gold standard, such as during the Civil War, you would see on, say, a U.S. $20 note, the words that says may be exchanged, or this is worth essentially 1 ounce of gold. So you would be able to take that U.S. $20 bill and exchange it for gold, right? Now, what happened in 1933 is FDR essentially took that right away from the citizens of the United States. He said it was illegal for individual Americans to own gold, and it was illegal. They would not redeem U.S. bills for gold, right? So foreign governments could still do that. And what they did was it was originally a standard of $20 U.S. dollars to 1 ounce. But after FDR essentially closed the gold window to the American citizens, they devalued the U.S. dollar and changed it to $33 an ounce.
I see.
So that enabled them to inflate their currency base, right?
Well, let's see if we can talk a little bit about what's going on right now, what's worked, what is working right now, and with the current economic situation, with the money crunch, if you will, the credit crunch. Maybe we can talk a little bit about what went wrong with the way the system was set up, because obviously there were some inequities, and maybe we can talk about what went wrong, and maybe if we can, are there any quick fixes to this dilemma? Yeah.
Well, I'll tell you. I mean, here's the issue, right? Is that by 1971, the Americans had spent so much money, right? After World War II, we went on to the Bretton Woods system, and what that established was a world dollar standard. So essentially, the world, apart from the Eastern Bloc, obviously. But the entire world went on a U.S. dollar standard. The Americans held the gold in Fort Knox, and everybody held American dollars. We did. Countries still held gold in their central bank reserves, but they also started holding U.S. dollars as their reserve currency. Now, by 1971, the Americans had spent so much money on, Johnson's Great Society project, the Vietnam War, all these various issues that countries such as France were demanding their gold. So they would ship their American dollars back to the U.S. and they would take their gold back. Now, so what happened is that Nixon went off the gold standard. He closed the gold window, and the world went on a pure fiat money system.
Right.
So there was no backing of any currency in the world anymore.
So how is that sustainable? I mean, if you're offering a currency that's basically guaranteed by the government, because that's what the American government at this point is saying, we've got our dollar, we guarantee the value of that. How do you maintain a clear value if it's not based on anything except the government guarantee?
Well, that's the thing, right? It's based on the guarantee that citizens will work and pay taxes to the government. I mean, that's exactly the issue we've had, right? Mm-hmm. So in the last 40 years, since leaving the gold standard completely and cutting the last link to gold, you've seen a massive inflation of U.S. currency, U.S. debt, and you've seen a massive inflation of debt around the world. So essentially what's happening now is that I think Joe Salerno, it's called dirty floating, right? So all our currencies are floating against each other, mm-hmm. But then occasionally what countries will do to, say, gain a perceived advantage, they'll inflate their currency. So they'll devalue it in the world market, and they'll be able to increase exports or something like that. Right. And essentially that is exactly what we're living in now. We're living in the long-run effects of the final break to something tangible, to a real, and of course that is exactly the problem. It's not sustainable.
Well,
right?
And how does a country like the United States, if you will, restore its currency value without moving, say, back to the gold standard? I mean, at this point, you hear stories every day about how gold is basically being undervalued by central banks. It's being undervalued through the sale of ETFs. Mm-hmm. And so because this paper gold, if you will, the ETFs is sort of offsetting the value of the tangible gold.
Yeah. Well, I mean, the only way that the good thing about gold, the thing that gold did was it put a restraint, a limit on the amount that the government could do, on the amount that the government could spend, right? And so what we've entered now since 1971 is essentially an unlimited. The only way that the Americans will be able to retain the value of their dollar is if they actually stop spending, right? The government actually has to, cut the budget,
right?
Pay down its debts, all these sorts of things. But for the United States, because its currency is the world reserve currency, there is virtually no incentive for them to do it, right? A smaller country like Zimbabwe, say. I mean, you can see what happens there when they just, engage in unlimited printing. Essentially, you have a runaway. You have a massive currency devaluation and the destruction of the currency. You look at a country like
they have $1 trillion bills over in Zimbabwe.
Oh, $100 trillion bills. It's insane. Chile in the last 40 years has destroyed its currency 4 times. Mm-hmm. Right. So you've had since the entire world has gone off the gold standard. You've seen many massive currency devaluations and currency destructions, and it's incredibly damaging to the citizens of those countries, right? Because they can't save any money, they can't work towards the future. They never know essentially how to calculate properly. It hurts businesses because they can't invest properly. They don't know what kind of return they need to earn on their goods and services,
right?
Because if they let's say they invest in a machine $1 million, and then they charge a rate of profit, or they earn a rate of profit enough to reinvest in that machine in 5 years at $1 million, and then in 5 years hits, all of a sudden that machine is $5 million. That company is going to go bankrupt. So it has the ability of governments to inflate the currency massively is incredibly damaging, and I mean, that's what we've come to, right? The reason why the American dollar has not massively devalued in the way that, let's say, one in Zimbabwe has is because it's the world reserve currency. Central banks around the world hold it, and they don't want to see the value of those holdings sort of just disappear overnight, right? Because if the Canadian government is holding, currency, U.S. currency as part of its assets, and those assets go down to zero, all of a sudden our credit rating goes. I mean, it will just mess up the entire system.
No, you're right, absolutely.
So what we're seeing around the world right now is various central banks. Unfortunately, Canada sold off the last of its gold in the late '90s. What you're seeing around the world in India, China, Mexico, Thailand, various central banks in the world over the last 5 years have become net buyers of gold. Right. So for the last 20 years or so, or 30 years, central banks around the world were net sellers of gold. They were selling their gold reserves. But now, since 2008, these central banks have become net buyers of gold. So the India bought 400 tons of gold from the IMF a little while ago.
So are these countries buying up gold then just as a way of protecting themselves against the possibility of, say, the American dollar going the way of Zimbabwe, for instance? I mean, that's obviously a stretch, if the collapse comes, if you will. But is that going to be gold's role then during this situation if our current dilemma doesn't right itself?
Rectify, yeah. Well, yeah. I mean, nobody can know the future, right? But I'm saying that we've had a 2,500-year track record with gold, and we've only been on this fiat currency standard for 40 years.
Right.
So my bet is on gold as or some type of asset-backed standard, right? I mean, you can back currency with whatever you want, but what central, and we're starting to see that come out in the market, right? I mean, if PayPal started issuing its own currency, that was tradable against other currencies. If it was, let's say PayPal bought 100 tons of gold, and said we're going to issue PayPal dollars, that becomes a competing currency, right? That competes against other currencies.
Absolutely.
Now, what happens though is, of course, the governments don't want this to happen. Right? The U.S. dollar doesn't want a competing currency out there that's going to make it devalue. And this is when you get into geopolitics, right? Let's say the Indians have decided they've got enough gold in their reserves, and they say we're gonna back the rupee with gold, or if China says we're gonna take the renminbi, we're gonna depeg it from the U.S. dollar, and we're backing it with our gold reserves, then all of a sudden you're going to see a flight to the Chinese renminbi is going to become the most valuable currency in the world, and the U.S. dollar will tank.
Right.
So it's, but of course that's we're essentially the U.S. The United States of America in the year 2011 is the new Rome, essentially, right? It's the new empire. It's a globe spanning empire. They have the most powerful military in the world, so that you might say that could be possibly a dangerous move by the Chinese.
Well, it would definitely be a provocation, that's for sure, and that's something we don't want to see as we enter the new millennium. I mean, we're only 10 years into this century, and we don't want to repeat of last century, do we?
No, well, exactly. I mean, it was the most blood-soaked century in the world, and that was it. And what's interesting is that through the preceding centuries, we came up with the idea that there should be a separation of church and state,
right?
Because of all the damage that had wrought in humanity, and if you look at the 20th century, I think what we really need to do is have a separation of church or state and economy, right? If you look at the 20th century, the great ideological battles were fought over essentially economics, whether a capitalist free market system would work over a planned economic system. And the proof is in the pudding. The planned economies of the East fell apart, and now what we're seeing is the centrally planned government monopoly sections of our own Western economies,
Mm-hmm.
we're seeing those disintegrate.
Right.
So
Well,
20 years ago, the Soviet Union fell apart. 20 years later, now we're seeing, the chickens are coming home to roost
Exactly.
in the planned, essentially the centrally planned sections of our own economies.
Well, that sounds like a great topic for our next show. I want to bring it to a close here, but I want to thank you for being on the show today, Redmond. And as the listeners will know, we're going to be interviewing Chris Horlacher as well,
Okay.
who you're familiar with, and we're going to be basically asking him the same questions or putting it to him the same way. But the separation of state and economy, that sounds like a great topic for our next show. I want to thank Redmond Weissenberger, who is the director of the Ludwig von Mises Institute of Canada. You can check that out at www.mises.ca. Is there another way that our listeners can contact you, Redmond?
No, that's fine. It's and it's Mises, MISES.ca. And they can always send me an email at Redmond, REDMOND, at Mises.ca. And I might note that the Mises Institute of Canada is a registered charity within Canada. So if you'd like to get a little bit of money back from from the government in your taxes and help a good cause, you can donate right up to January 1st for your 2011 taxes.
Well, there you go. Well, thanks again, Redmond. I look forward to our next chat, hopefully around the same time next month. We want to make Redmond Weissenberger a regular subject, if you will.
Cool. Yeah, thank you very much.
Thanks again, Redmond. You have a great day, and happy holidays to you.
Yeah, happy holidays to you.
Bye-bye.